Good morning, participants. I hope you are all able to hear me and see me. If anyone is having audio or video problem, please point out before we start today's session. So in our last session, we started discussing about IS 12, Accounting Standard 12, which basically applies to current tax and deferred tax treatment, accounting treatment for current tax and deferred tax. See, when a company makes financial reporting through its profit and loss account, it calculates tax based on the profit that is determined in accordance with the financial reporting requirements. But the tax laws in different countries are different. So as they have to also, when they actually have to pay the tax, it has to be calculated based on the tax laws. So there could be a difference. Profit calculated based on the financial reporting requirements could be different, or tax payable under the financial reporting requirements and the tax payable as per the tax laws of the country can be different. So that's why the concept of current tax and deferred tax comes in. So I will try to give you an example, a very simple kind of example to make you understand how profit or tax calculated as per in the financial reports, that is profit and loss, can differ from the tax payable, actual tax payable by the entity. So let's take an example of a company over a period of 4 years. Year 1, year 2, year 3 and year 4. Let's assume the profit before tax is same for all those 4 years. Let's say 500,000. Now the profit before depreciation and taxes. We'll say profit before depreciation and taxes is same for these 4 years, 500,000. Now the company has fixed assets valued at 200,000. The company is having fixed assets valued at 200,000, which the company is going to depreciate over these 4 years. So how much will be depreciation? On straight line basis, 50,000 will be depreciated each year. So the profit before tax will be 450,000 for all these 4 years. This is as per the financial reports. In the profit and loss account, company has calculated the profit before depreciation and taxes at 500,000. Let's say it is uniform over this 4 year period, and the company's fixed assets is valued at 200,000, which they are going to depreciate based on straight line method over this 4 years. So the depreciation that will be charged to the profit and loss account will be 50,000 for each of these 4 years. So the profit before tax will be 450,000. If the company is required to pay tax rate at the rate of, let's say, 30%, tax at the rate of 30%, so company will calculate what is the tax liability on this profit before tax. It will be 135,000 for all these 3 years, 30% of 40. Is that clear? So this is what company will charge towards or make a provision for tax payable on this profit. Now let's say the tax law of that particular country allows the asset to be depreciated over a 2-year period. As per the tax law, the asset can be depreciated over a 2-year period. No lecture on Monday. Your lecture days are Wednesday and Friday. From Monday and Wednesday it has been changed to Wednesday and Friday, so there is no lecture on Monday. We are continuing with what we did up to last Friday. Okay. Now, let's say that as per the tax law, the fixed asset can be depreciated over a period of 2 years. The tax law permits or the tax law requests that this particular fixed assets or this fixed asset should be depreciated over a period of 2 years. So, as per tax law, what will be the depreciation? As per tax law, depreciation will be, for the first year will be 100,000 and for the second year it will be 100,000, and since the profit is fully depreciated, there will be no further depreciation in the third and fourth year. So as per tax law, profit before tax will be 500 minus 100, so 400,000 for the first year, 400,000 for the second year, 400,000 for the 500,000 for the third year, and 500,000 for the third year because there are net depreciation. Is that clear? This is the tax profit before tax calculated as per the financial reporting that is being done by the company. In the financial report or in the profit and loss account, they will be showing profit at PBT at 450,000 for all those 4 years. But when it comes to depreciation to be calculated under the tax law, the depreciation for the first 2 years will be 100,000 each, and there will be no further depreciation in the third and fourth year. So the profit before tax will be 400,000 in the first year, 400,000 in the second year, 500,000 in the third year, and 500,000 in the fourth year. So what will be the tax? Actual tax, current tax will be 120. 30% of 400,000, so 120 in the first year, 120 in the second year, 150 in the third year, and 150 in the fourth year. Total tax remains same. Total tax will be 540. Total tax here also will be 540. Total tax payable will be same. But the distribution of the tax will differ. Distribution over the years will be different. So the company in the profit and loss account have provided for tax payment of 135,000. Actual tax payment will be 120,000. So the difference will be shown as a deferred tax liability. So in the company's balance sheet, the difference between the tax payable or tax chargeable under the financial reporting profit and loss account and the actual tax, current tax, will be shown as a deferred tax liability. Because ultimately it has to be paid. See, here in the third year, 135, instead of 135,000, they have to pay now 150,000, 15,000 more. In this year, they are paying 15,000 less. Similarly, in the second year, they are paying 15,000 less than what they calculated. But in the fourth year, they have to pay 15,000 more. So this will be deferred tax liability. Company will be actually paying a tax of 120, and a deferred tax liability of 15,000 will be created for the first year. Similarly, deferred tax liability of 15,000 will be created for the second year. In the third year, this deferred tax liability will be used to pay that 150,000 against 135,000, which is tax payable as per the financial report. So this is the concept of deferred tax. Why it is happening? Because the carrying value of the asset calculated as per the financial reporting and the carrying value of the asset calculated as per the tax law are different. This is called what is called a temporary difference. See, what will be the carrying value of the asset? If we charge a depreciation of 50,000, in the first year the carrying value of the asset will be 150,000 now. But as per tax law, when you charge a depreciation of 100,000, the carrying value of the asset will be, the tax base will be 100,000. So this difference is a temporary difference. So this is the concept of current tax and deferred tax, because when it comes to payment of tax under tax laws, the tax base of an asset or liability can be different from the carrying value of the asset or liability. That difference we call a temporary difference. And because of temporary difference, we may have to create a deferred tax liability for paying the taxes in future, or if you are paying more taxes than what if you are paying more taxes the current year compared to what is payable under the financial reporting standard, that will be treated as a deferred tax asset, which will be adjusted against taxes of the future years. That is the concept of deferred tax accounting. So I just wanted to give you a very small example. I hope you have understood. This is simply because the difference between the way the company depreciates the asset as per the financial reporting requirement and the company is required to depreciate a particular asset as per the tax laws. So we will talk about the concept of calculating the tax base, temporary differences, current tax, deferred tax and subsequent year adjustments, the presentation and disclosure requirements regarding current tax and deferred tax, and the difference between IFRS and US GAAP. The main reason why IAS 12 deferred tax has to be provided for is that the international financial reporting standards recognition criteria are different from those that are normally set out in the tax laws. Thus, there will be income and expenditure in financial statements that will not be allowed for taxation purposes in tax laws of a particular jurisdiction. So the objective of IAS 12 is to prescribe the accounting treatment for income taxes. The IAS 12 basically deals with the accounting treatment for income taxes. The main issue addressed in the IAS 12 is the accounting for the current and future tax consequences. Accounting for the current tax and future tax consequences, that is the main objective or main issue addressed in the IAS 12. So in the transaction or events which take place over the year leads to our statement of profit and loss. And future recovery settlement is done through what is called deferred taxation. So IAS 12 prescribes the accounting treatment for income taxes. The main issue is how to determine accounting for current and future tax consequences of transaction events of the current period in an entity's financial statement, the future recovery or settlement of carrying amount of assets or liabilities in an entity statement of financial position. So these are the two issues dealt with under IAS 12. Remember, accounting profit is the profit or loss for a period before deducting the tax expense. That is what is called accounting profit. Before deducting the profit or loss for a period before before deducting the tax expense, whatever profit is earned by a company is basically the accounting profit. It is the profit or loss for a period before deducting the tax expense. Now, tax profit or tax loss is the profit or loss for a period in which income tax is payable or recoverable if it is loss. So there are two concepts, accounting profit and tax profit. So this is what we are showing as the accounting profit, and this is what is showing as the tax profit. In this particular example, this is accounting profit, and this is tax profit. So accounting profit is the profit or loss for a period before deducting the tax expense. The profit or tax loss is the profit or loss for a period in which income tax is payable or recoverable if loss. So tax expense is nothing but current tax plus deferred tax for the period. So this is the tax expense. This 135 is the tax expense. It is consisting of current tax of 120 and deferred tax of 15,000. So tax expense is nothing but current tax paid to the tax to the government plus deferred tax for the period. So the current tax is 120, tax expense is 135, the remaining 15 is a deferred tax liability. Similarly, in the second year, current tax is 120,000, deferred tax is 15,000, so the tax expense is 135,000. The tax expense will get reflected in the profit and loss account. So current tax is the amount of income tax payable or recoverable in respect of tax profit or tax loss for a period. Whereas deferred tax liabilities are the amount of income tax payable in the future in respect of temporary taxable difference. Deferred tax or deferred tax liabilities or deferred tax assets are the amount of income tax payable or recoverable in the future in respect of temporary taxable differences. So deferred tax assets are the amounts of income tax recoverable in the future periods in respect of the deductible temporary differences, the carry forward of unused tax losses, and the carry forward of unused tax credits. Tax base of an asset or liability is the amount attributed to that asset or liability for tax purpose. Like say, the tax base of the fixed assets in the second year is only 100,000. That is the amount attributed to that particular asset for tax purposes. So tax base of an asset or liability is the amount attributed to that asset or liability for tax purposes. And temporary differences are basically differences between the carrying amounts of an asset or a liability in the balance sheet and its tax base. Remember, an entity will settle its liabilities and recover its assets eventually over time, and at that point the tax consequences will crystallize. Like for example, if a machine has a carrying value in the financial statement of 5 million and its tax base is 2 million, that means for tax purposes only 2 million will be allowed as depreciation charges. Then there is a taxable temporary difference of 3 million. So let's look at this example. The balance sheet shows an interest receivable of 5,000. What it is? The interest receivable of 5,000 is a asset. So balance sheet shows an asset, interest receivable of 5,000. Supposing there could be two situations. If the tax law says the interest should be taxed on cash basis, if the tax law permits or requires that interest should be taxed on cash basis, then the tax basis is nil because it is interest receivable. The cash has not yet been received. So the tax base will be nil for this liability, and temporary difference will be carrying value of the liability in the balance sheet is 5,000. Tax base is nil. So temporary difference will be 5,000. The temporary difference will disappear in future when the interest is actually received in cash. In that year, the tax base will become 5,000, the interest receivable. So automatically the difference between the carrying value and the tax base will disappear. So temporary difference, why you call it temporary difference? Because that kind of difference only exists for a temporarily for a period of time. If the interest is taxed on accrual basis, if the tax law requires that interest earning should be taxed on accrual basis, then the tax base is 5,000. The liability for that liability for the tax purpose, the liability will be recognized at 5,000. The tax base is 5,000 and temporary difference will be nil because the carrying value of that liability in the balance sheet is also 5,000. So there is no temporary difference. So we'll talk about two kinds of temporary difference, a taxable temporary difference and deductible temporary difference. This is a taxable temporary difference. There could be also situations where there could be a deductible temporary difference. So the key to understand IAS 12, accounting profit and loss versus taxable profit and loss. On one side we look at what is the accounting profit and loss, and we look at what is taxable profit and loss. Accounting profit and loss versus taxable profit and loss gives us the concept of current tax versus deferred tax. On taxable profit and loss you pay current tax. On accounting profit and loss you calculate tax expense. The difference between the tax expense and the current tax is the deferred tax or deferred tax asset or deferred tax liability. The key element in understanding IAS 12 is to understand the difference between the accounting profit and loss and taxable profit and loss on one side, and the difference between the current tax and deferred tax on the other side. As I told you, in this particular example I gave you, this is the accounting profit and loss for the first year for 450,000, whereas the taxable profit and loss is 400,000. Current tax will be calculated on taxable profit and loss, that is 120,000, but tax expense will be calculated on the accounting profit and loss as 135,000. So that difference is the deferred tax liability. So we show basically with this figure on your screen, diagram on your screen, we try to show the difference between the accounting profit loss and taxable profit loss. So accounting profit or loss is the profit or loss for the period before deducting tax expense. That is 450,000 for each of these 4 years. Taxable profit or loss, it is a profit or loss for that period determined in accordance with applicable tax rules. So it is nothing but accounting profit or loss plus expense recognized but non-deductible for tax purpose. For in arriving at the accounting profit or loss, we have taken into account certain expenses. Some of these expenses may not be deductible for tax purpose. So those expenses have to be added back. Expenses which have been recognized while determining the accounting profit and loss, but which are non-deductible for tax purpose, have to be added back. Similarly, income which has not been recognized in calculation of the accounting profit and loss, but included under tax loss, minus expenses not recognized but deductible for tax purposes, minus income recognized but not recognized under tax loss. So we have to make adjustment. Accounting profit and loss have to be adjusted to arrive at the taxable profit and loss by adding the expenses recognized but non-deductible for tax purpose, by adding back income not recognized but included under tax loss, and by deducting expenses not recognized but deductible for tax purpose, and deducted by income recognized but not recognized under tax loss. So what else? Can we have an expense which is not recognized, expense which is recognized but non-deductible for tax purpose? Do you have an example? Like the cash expenses above 20,000. If any expenditure is made in cash above 20,000, it can be included in the profit and loss statement. It can be recognized for the calculation of profit and loss, but the tax law will not allow it to be deducted. Any entity, organization, if they make a cash expenditure of 20,000, a single cash expenditure of more than 20,000, then they may recognize this expenditure for adding at the accounting profit and loss, but for calculation of taxable profit or loss, this expense will not be allowed to be deducted. That is as per the tax law of the country, of our country. So let's look at how current income tax is derived. Current income tax is the amount of income tax payable or recoverable in respect of the taxable profit or tax loss for a period. So from the accounting profit and loss, you have to arrive at what is called the taxable profit and loss, apply the tax rate. How will you journalize it? We journalize it by debit expenses in the net P&L and credit the tax liability. So current income tax is calculated as the taxable profit or loss multiplied by the tax rate. That if for an entity profit as per taxable profit or as per tax loss for the year 2015 is 200,000 and tax rate is 35%, then the current income tax for the year is 70,000. If the taxable profit for the year is 200,000 and tax rate is 35%, then the current income tax for the year is 70,000. So how will you journalize it? So journal entry will be debit expenses in the net P&L, 70,000, credit tax liability in the balance sheet, 70,000. Now we'll talk about difference between current and deferred tax. In the arriving at preparing the financial statement of profit and loss, we use from the accounting profit, we will be charging what is the tax expense or tax income. A part of that will be the current income tax. The difference between the tax expense and current income tax will be the deferred income tax. So deferred tax is simply an accounting measure for the internal purpose. Current income tax is payable to the tax authorities, which you have to really pay out to the tax authorities. But the deferred tax is basically an accounting measure for the internal purpose. So current income tax is payable to the tax office. It is based on the taxable profit and loss, and it is for the current period. Substance is, it has to be paid to the tax office. Basis is taxable profit and loss, and timing is current period. Deferred income tax is nothing but an accounting measure. It's basically based on temporary differences. Temporary difference, basically the tax-based difference between the carrying value of an asset or liability and the tax base. So it arises due to temporary differences, and it has to be adjusted over the future periods. Consequence will be over the future periods. That is deferred income tax. So deferred income tax is nothing but income tax payable or recoverable in future periods in respect of the temporary differences, unused tax losses and unused tax credits. So deferred income tax is nothing but income tax payable, or it can be also recoverable in future periods in respect of the temporary differences, unused tax credits or unused tax losses. And temporary difference, as you know, the difference between the carrying amount of an asset or liability and its tax base. So temporary difference multiplied by the tax rate will give you deferred income tax plus unused tax losses and unused tax credits. So deferred income tax is income tax payable or recoverable in future periods in respect of the temporary differences, unused tax losses and unused tax credits. It is calculated on the temporary differences multiplied by the tax rate for the year. And temporary difference, as you know, is the difference between the carrying amount of an asset or liability to its tax base. Any question up to this? Tax base is the amount attributed to the asset or liability for tax purpose. Please understand. And deferred income tax is basically deferred income tax due to temporary difference is nothing but, and temporary difference is carrying value of the asset or liability minus tax base. So deferred income tax is calculated by multiplying the temporary difference with the tax rate applicable. Example. Let's take the case of an asset. Let's start with asset items and then liabilities item. An entity buys a machine for 100,000. Sorry, 1,000. Entity buys a machine for 1,000 The tax depreciation allowed on the cost of the machine is at the rate of 20% of WDV. The tax law allows depreciation on the cost of the machine at the rate of 20% of WDV. So at the end of the first year, the tax base of the asset will be 800, that is 1000 minus 20% of 1000. That will be the tax base. So we are looking at some examples of tax base. If the tax law allows the machine to be or requires the machine to be depreciated at 20% written down value method, under written down value method, so at the end of first year, the machine which was costing 1000, the carrying value was 1000. Now the amount attributed to that particular machine under tax law will be 1000 minus 20% of 1000, that is 800. That will be the tax base for that machine or that asset. Second example, there is an interest receivable of 2000 which appears as a asset in the books of the entity. However, if interest receivable is taxable only on cash basis, that means it will be taxed only when it is received. The interest receivable will have a tax base of 0 because it has not yet been received. Interest receivable is the amount of interest which is treated as an income but not yet received. So we are treating it as an actual basis interest receivable. But since tax law only allows that interest receivable should be taxable on cash basis, so the tax base of the interest receivable will be 0, but the carrying value of the interest receivable in the balance sheet is 2000. So the temporary difference is 2000. As I told you, the temporary difference will disappear, will cease to exist when the interest is actually received. Similarly, on the liability side, we can look at some examples. A provision of 5,000 for the restructuring of a company was recognized as per IS 37, as per the International Financial Reporting Standard 37. A provision of 5,000 for restructuring of the company was recognized. But the local tax law allows deduction of restructuring costs when they are actually incurred. That restructuring cost has not yet been incurred, only it has been provided for. So under IS 37, we have provided for the restructuring cost of 5,000 by debit to the P&L account. But the restructuring cost has not yet been incurred. And tax law allows deduction of the restructuring cost when they are actually incurred. So the tax base of the provision is 0. So the tax base of the provision is 0 when it is in the year it is actually incurred. The tax base of the provision, there will be no temporary difference. Second example. So the 5,000 which was appearing as provision for restructuring, first example I am talking of, it was a liability item in the balance sheet. The carrying value was 5,000, but its tax base is 0. So temporary difference is 5,000. And the temporary difference will not exist in the subsequent year when that restructuring cost is really incurred. Second example. A balance sheet shows the accrued interest on liability for $500. Accrued interest on liability for $500. Tax laws permit deduction on cash basis only. So it is on the liability side of the balance sheet. It is showing accrued interest on liability at $500. Now the tax law permits deduction on cash basis only. So only when the liability is made on actually paid out, then tax law will allow it as a deductible expense. So the tax base is 0. So the amount that will be attributed under tax laws to that particular item of liability will be 0. But if the tax law permits on accrual basis, then the tax base will become $500. So it depends on the tax law of the country. So the following figure, the diagram represents actually how temporary differences or deferred income tax comes into existence. Debit balances in the financial statements are compared to tax computation. This leads to what we call deferred tax credit balance. This is due to taxable temporary difference, so it gives rise to deferred tax liability. Similarly, credit balances in the financial statements are compared to tax computations or any tax loss or credit is carried forward. This leads to deferred tax debit balance which is on account of deductible temporary difference, we get deferred tax asset. So IS12 recognizes deferred tax liability for all taxable temporary difference, deferred tax assets for all deductible temporary differences. So there are taxable temporary differences, there are deductible temporary differences. So in respect of taxable differences, temporary differences, we get the IS12 recognizes deferred tax liability. In respect of deductible temporary differences, IS12 recognizes deferred tax assets. Having discussed about what we called, or having tried to explain to you what is taxable temporary difference or deductible temporary difference, now we'll talk about the permanent differences. What do you mean by permanent differences? Permanent differences arise from items of income and expenditure that have been included in the calculation of accounting profit but never will be included in the calculation of taxable profits. So the cash expenditure of more than 20,000, so an expenditure of more than 20,000 incurred in cash may be recognized, will be recognized as an expenditure in the profit and loss account, but it will not be recognized in the calculation of taxable profits. That is a permanent difference. So any item of income and expenditure that have been included in the calculation of accounting profit but will never be included in the calculation of taxable profit is called a permanent difference. Now IS12 doesn't directly talk about permanent differences. In general, if an item has no tax effect, then there is no deferred tax on it. If an item has no tax effect, like the expenditure, cash expenditure of 20,000 or above 20,000 for a single cash expenditure, it has no tax effect. So there is no deferred tax on it. Deferred tax only can apply to those items of income and expenditure where there is a tax effect and there is a difference between the tax base relating to the item and the carrying value of that asset or liability in the balance sheet. If those items like economic benefits or obligation that will not be taxable, the tax base of the asset or liability is equal to its carrying amount and there is no taxable temporary difference. So like say example, entity X provides a loan of 100,000 to entity Y. At 31st December 2050, entities Y account shows a loan creditor of 200,000. They may have taken loans from others also. The repayment of the loan has no tax consequences. Therefore, the loan creditor has a tax base of 200,000. So no temporary taxable difference arises. Carrying value is 200,000, tax base is also 200,000 because the loan repayment has no tax consequences. Since loan repayment has no tax consequences, the tax base for loan repayment will be 200,000, same as the carrying value. So there is no taxable temporary difference. So this is what we mean. In India, we call it permanent difference. Under Ind AS, this is called permanent difference. Permanent difference is basically if an item of income and expenditure that have been included in the calculation of accounting profit but never will be included in the calculation of taxable profit or loss. That is what we call permanent difference. But permanent difference doesn't contribute to any deferred tax asset or liability. Only taxable temporary difference or deductible temporary difference can contribute to deferred tax liability or deferred tax asset. So let's look at an example. Let's look at an example, case study 1. Let's try to understand the temporary differences in these cases. A machine costs 100,000 with depreciation to date of 18,000 and has a capital allowance of 30,000. So what will be the temporary difference? A machine is costing 100,000, that is the value of the original value of the asset. Depreciation, accumulated depreciation to date of 18,000. So the carrying value of the asset in the balance sheet is 100,000 minus 82,000. So carrying amount is 82,000. Since it has a capital allowance of 30,000, capital allowance is provided as per the tax laws. Capital allowance of 30,000 means the machine, under the tax law, machine has been depreciated to the extent of 30,000. So how much is the value attributed to that particular asset based on the tax laws is 100,000 minus 30,000, that is 70,000. So the tax base of the machine is 70,000. Whereas the carrying amount is 82,000. So the temporary difference is 12,000. Is that clear? See, the machine is costing 100,000, the accumulated depreciation is 18,000. So what is the carrying value of that asset? 100,000 minus original cost minus accumulated depreciation. 100,000 minus 18,000, so 82,000. But the machine has a capital allowance of 30,000. Capital allowance is provided under tax laws. So that means machine has been, as per tax laws, the machine, depreciation of the machine is 30,000. So that under the tax laws, the value that will be attributed to the machine will be 100,000 minus 30,000, 70,000. So the tax base is 70,000 for the machine. Whereas the carrying amount is 82,000. So temporary difference is 12,000. Example 1. That is on the asset side. Interest receivable in the statement of financial position is 1,000. The interest will be taxed when received. That means on cash basis. So this is an income. Interest receivable in the statement of financial position is 1,000. So it is shown on the asset side of the balance sheet as interest receivable. The carrying amount is 1,000. But so far as the tax law is concerned, this interest income will be taxed only when actually received on cash basis. So the tax base is 0 because the interest has not yet been received. Tax law only will recognize it as an income when it is received. So the tax base of this particular item of asset is 0, whereas the carrying amount is 1,000. So difference is the temporary difference of 1,000. Is that clear to everyone? Similarly, trade receivables have a carrying amount of 10,000. The revenue has already been included in the taxable profit. That means for the calculation of taxable profit, this revenue has already been included. So it has been the value attributed to that revenue is under the tax law is 10,000. So the carrying amount is 10,000, the tax base is also 10,000. So temporary difference is not there. Trade receivables have a carrying amount of 10,000. This revenue has already been included in the taxable profit. So when you arrive at the calculation of taxable profit, this is to be recognized as an income. So the tax law allows the income to be recognized, this income to be recognized on accrual basis. So the carrying amount in the balance sheet is 10,000. Tax base is also 10,000, so there is no temporary difference in respect of this asset. Is that clear? Fourth example. An entity writes down its inventory by $500 to a net realizable value of $4,500. But this reduction is ignored for tax purposes until the inventory is sold. So the carrying amount of the inventory in the balance sheet is 4,500, but the tax law will not recognize this reduction of the inventory value till the inventory is actually sold out. So the tax base of the inventory still remains 5,000. Although the carrying amount of the inventory is 4,500, the tax base remains 5,000. So the temporary difference is 500. So whenever there is a difference between the tax base and the carrying amount, the temporary difference may arise. And more important is that particular item of income or expenditure or asset or liability must have a tax effect. If it doesn't have a tax effect, then it doesn't result in a deferred tax asset or deferred tax liability. Although there could be a temporary difference, but it will not result in a deferred tax asset or deferred tax liability. We look at the liability side, or items of liability. Examples. Current liabilities include accrued expense of 1,000. This is deductible for tax on cash paid basis. So the carrying amount, the current liability, it includes accrued expense of 1,000. Okay, so the carrying amount is 1,000. I'll go back to the fourth example, just wait. Okay, Dibba, I have seen your question, explain the fourth example, I'll do it. Since I've started this, let me finish it, then I'll go back to the fourth example. Will that do? Okay. Current liabilities include accrued expenses of 1,000. And this is deductible for tax only on cash paid basis. So it's a liability. Accrued expense of 1,000, but this will be recognized as a deductible expense under the tax laws only when it is incurred. That means on cash paid basis. So the carrying value of the liability in the balance sheet is 1,000, but the tax base of this particular liability is 0 because the expense has not yet been incurred. So the temporary difference will be again 1,000. Is this clear? Current liabilities in the balance sheet include accrued expense of 1,000, but as per the tax law, this will be treated as a deductible expenditure only when it is incurred. That means on cash basis. It has not yet been incurred. So that's why we are saying it is an accrued expense. So although the carrying amount in the balance sheet is 1,000 for, that is the carrying amount, but the tax base is 0. Because the tax base, since it has not been incurred yet, the tax base, the amount attributed to this liability will be 0 as per tax laws. So the temporary difference will be again 1,000. Is that clear? Then I go back to the fourth question and then I'll come to the last question. Is this clear? So going back to the fourth one, which Dibba wants me to explain again. An entity writes down its inventory by $500 to a net realizable value of 4,500. Earlier the inventory was valued at 5,000. Now entity found maybe there is an impairment of the inventory, the value of the inventory should be written down. So they wrote down the inventory by $500, from 5,000 it wrote down to 4,500. So write down expense was incurred, so it was written down to 4,500. So the carrying amount of this inventory in the balance sheet is how much? 4,500. Is that clear? Since the entity has written down the inventory from 5,000 by $500 to a realizable value of 4,500, so the inventory is shown in the balance sheet at 4,500. That is the carrying amount of the inventory in the balance sheet. But this reduction is ignored for tax purposes until the inventory is sold. The tax authorities will not allow this reduction to be recognized as expenditure. That writing down of the inventory value is an expenditure. So the tax law doesn't allow this reduction of the inventory value as an expenditure for the purpose of tax purposes until the inventory is actually sold out. Inventory is still held by the company. Till the time the inventory is actually sold out, this reduction in the inventory value will not be recognized or it will be ignored for tax purposes. So how much amount or how much value will be attributed as per tax laws to the inventory, that old 5,000? That reduction will be ignored. So that carrying amount is 4,500 and tax base is 5,000. So temporary difference will be 500. Is that clear, Dibba? Is it clear to you? Okay. Then we'll go to the last item. Accrued expenses have a carrying amount of 5,000. The related expenses have been deducted for tax purposes. So the carrying amount is 5,000. Tax law also allows this expenditure to be allowed this deductible expenditure on actual basis. So that's why the related expenses have been deducted for tax purposes. Because the tax law allows this expenditure to be treated as a deductible expenditure even on actual basis, so that's why it has been deducted for tax purposes. So the carrying amount is 5,000, tax base is again 5,000. The amount that will be attributed to this item of liability will be 5,000 because the tax law allows it to be recognized on actual basis. So the temporary difference is 0. Carrying amount is 5,000, tax base is 5,000, so no temporary difference. Since there is no temporary difference, this will not give rise to any deferred tax asset or deferred tax liability. Is it clear, all the examples? We look at another case study. An entity AB PLC has the following temporary differences. Okay, we'll do it after a break, short break, we'll do this. There are 2 more case studies, we'll continue with those after the break. So we'll have a short break at this point of time. So let's have a short break and then we'll resume with this case study 2. Welcome back after the break. So let's look at the case study 2. An entity AB PLC has the following temporary differences. Accelerated capital allowance on 30th June 2015 it was 400,000, 30th June 2016 it is 900,000. General provision disallowed for tax. Temporary difference on 30th June 2015 was nil. On 30th June 2016 it will be 50,000. Accrued pension liabilities, tax relief is given only on cash basis. 60,000 was the temporary difference on 30th June 2015 and 40,000 on 30th June 2016. Provision for unrealized profit. On 30th June 2015 the temporary difference was nil, but on 30th June 2016 it is 10,000. And loss relief being carried forward, temporary difference is 0 on 30th June 2015 and 30th June 2016 it is 100. So calculate the deferred tax provision required at each reporting date together with the movement of the deferred tax provision for the year ending 30th June 2016. The tax rate applicable for both reporting periods was 30%. So let's look at the deferred tax provision for each reporting date. So what is the question from Faisal Sheikh before I go to the solution? Final MT is far off. I cannot check, I have to check the date from your batch schedule. I cannot do it right now. We are in the middle of lesson 2. It will be followed by lesson 3, lesson 4. So you are almost, I would say 60-65% of the course has been covered. So another maybe 5 weeks, approximately 5 or 6 weeks. I cannot tell you the date right now. So let's look at this case study. So these are the various temporary differences on two different dates. Okay. So in respect of the accelerated capital allowance on 30th June 2015 it is 400. So the figures are here. So the deferred tax liability, if you look at the various temporary differences, add them up. Accelerated capital allowance it is 30th June 2015 is 400. General provision is nil. We are looking at 30th June 2015 now. Accrued pension liabilities, tax relief is given on the cash basis. So it is a liability side, so you have to take a negative. Temporary difference is negative 60. Then provision for unrealized profit is nil, loss if being carried forward is nil. So total temporary difference adding the assets and liability side comes to 340. 400 minus 60, 340. Similarly, as on 30th June 2016, accelerated capital allowance is 900. General provisions, which is disallowed for tax, is minus 50. Active pension liabilities is minus 40. Provision for unrealized profit is minus 10. And loss relief being carried forward is minus 100. So 900 minus 50 minus 40 minus 10 minus 100 is 700. Remember, the accelerated capital allowance is respect of the temporary difference in respect of assets. The rest are temporary difference in respect of liabilities like general provisions, accrued pension liabilities, provision for unrealized profits, and loss relief being carried forward. These are all on the liability side. So temporary differences will be deducted in this process from the temporary difference in respect of assets. So the net temporary difference as on 30th June 2015 is 340. And net temporary difference on 30th June 2016 is 740. So the deferred tax liability will be 30% of 340 as on 30th June 2015, and deferred tax liability will be 30% of 740, that is 210,000 as on 30th June 2016. So the net deferred tax liability will be additional deferred tax liability for charge to profit and loss will be 210 minus 102, that is 108 will be the charge to profit and loss. So that charge to profit and loss will increase the deferred tax liability by 108,000. From 102 it will go up to 210. Is that clear to everyone? Therefore, the charge to profit and loss as on 30th June 2016 will be the difference between the deferred tax liability on 30th June 2016 and 30th June 2015. The deferred tax liability has to go up from 102 to 210,000. This will be done by charging to profit and loss account. So the accounting profit will be charged by 102,000. So 102,000. So as a result, the deferred tax liability will be increased to 210,000 from the level of 102,000, obtaining at the end of 30th June 2015. Have you understood this case study or not? That's my point. If you have not understood, I will have it repeated. I will explain it again. Basically, we are looking at each of the two balance sheet dates. What are the various temporary differences in respect of assets and liabilities? The temporary differences in respect of assets minus temporary difference in respect of liabilities. That is what we are trying to work on. So the net temporary difference in respect of assets is 340,000 as on 30th June 2015 and 700,000 as on 30th June 2016. This is taxable temporary difference. So if you look at, some of these are taxable temporary difference and some of these are deductible temporary difference. Deductible temporary difference gives rise to deferred tax assets. Taxable temporary difference gives rise to deferred tax liabilities. So if you look at the various temporary differences, the first one, that is accelerated capital allowance, is a taxable temporary difference. Whereas the other ones like general provision, accrued pension liabilities, provision for unrealized profits and loss relief being carried forward, these are deductible temporary difference. So we take the net taxable temporary difference as on 30th June 2015 it is 340, as on 30th June 2016 it is 700. So the deferred tax asset or liability will be the tax rate multiplied by the net taxable temporary difference, that will be deferred tax liability. So 30% of 340 is 102,000. So the deferred tax liability as on 30th June 2015 should be 102,000, and the deferred tax liability for the subsequent year, that is 30th June 2016, should be 30% of 700 to 110,000. Now, how this deferred tax liability will go up from 100 to 210,000? It has to be charged. We have to charge additionally 108,000 to the profit and loss account and credit it to the deferred tax liability account. So we will be debiting profit and loss account by 108,000, which is difference between 210 and 102, and credit it to the deferred tax liability account. So deferred tax liability account will go up to 210,000 as at the end of 30th June 2016. I hope now this solution is clear to you. If you have any problem, you can please raise your hands or ask me questions. Third case study. An entity AB PLC owns an asset which has a historical cost of 100,000. That means the original purchase price is 100,000. The accumulated depreciation against the asset till the reporting date, that is 31st March 20X1, is 40,000. The asset is revalued to 90,000 on this reporting date and assume the tax rate to be 30%. Explain the deferred tax implication of this situation. The historical cost of the asset is 100,000. Accumulated depreciation against the asset till the reporting date, that is 31st March 20X1, is 40,000. So the carrying value of the asset on 31st March 20X1 is 60,000. You want to see the solution once more of the earlier one? Yes, I'll definitely show it. Just wait a minute. Then we'll go back to the earlier case study, show the solution once more, and then come to this case study. Okay, no problem. So I put the solution on your screen. I will raise it a little. Can you see it? Okay. The numbers have been taken from that case study on. All numbers. Tell me when you are last part of the solution. Yes, definitely. This is the last part of the solution. Tell me when you are finished. Okay, thank you. So I'll go back to the case study 3, third case study. An entity ABPLC owns an asset which has a historical cost of 100,000, accumulated depreciation against the asset till the reporting date, that is 31st March 2020X1, is 40,000. The asset is revalued to 90,000 on this reporting date. Assume the tax rate to be 30%. So you have to explain the deferred tax implication of this situation. Now one thing is sure, as on 31st March 20X1, the asset's carrying value was, before devaluation, was 100,000 minus 40,000. That is the accumulated depreciation, 60,000. The asset is revalued to 90,000. So the revalued amount will be shown in the balance sheet. Okay. So what is the deferred tax implication of this situation? So let's look at the solution here also. So the carrying amount of the asset before evaluation is 60,000, which is 100,000 minus 40,000. No problem about that. 100,000 was the historical cost. 40,000 is the accumulated depreciation. So the carrying amount of the asset before evaluation is 60,000. So in its tax basis, actually this is not mentioned in the example. The capital allowance for the asset was 50,000. The capital allowance means the depreciation that is allowed under the tax law. That was 50,000 at that point of time. That is not mentioned in the case study. So the difference between the carrying amount, tax base was basically 100,000 minus the capital allowance, 50,000. So 50,000 was basically the tax base of the asset. So the difference between the carrying amount and the tax base is 10,000 at that point of time. It's a temporary difference, so the liability will be deferred tax liability 10% of 30,000, 30% of 10,000, that is 3,000. Okay, so this thing was missing in the case study. What was the capital allowance on the asset? That was 50,000. Now revaluing the asset increases its carrying amount without altering its tax base. When you revalue the asset, its tax base doesn't change. So but the carrying amount will change. So revaluation has no immediate tax consequence, so that it will not affect the tax base. Therefore, the revaluation creates an additional temporary difference of 30,000. The asset is revalued from 60,000 to 90,000. That creates an additional temporary difference of 30,000. And so the additional deferred tax liability will be 30% of 30,000, which is 9,000. That has to be recognized. Is that clear? The revaluation gain gets disclosed. Revaluation gain of 30,000 will be disclosed as other comprehensive income and credited to the revaluation reserve account within other components of equity. In line with this treatment, the deferred tax expenses must be disclosed as tax relating to other comprehensive income debited to the revaluation reserve. So the additional deferred tax liability of 9,000 has to be disclosed as tax relating to other comprehensive income. It will be debited to the revaluation reserve. So revaluation reserve will be reduced by this 9,000. So we'll have to create a deferred tax liability in respect of additional deferred tax liability of 9,000 has to be recognized. Since revaluation gain is disclosed as other comprehensive income and credited to the revaluation reserve account, in line with this treatment, the deferred tax expense must be disclosed as tax relating to other comprehensive income, which will be debited to the revaluation reserve. So any question on this solution? If it is not clear, then you can ask me. So to create the deferred tax liability, you have to debit the revaluation reserve by 9,000. 30,000 will be credited to the revaluation reserve. It will be shown as a other comprehensive income, that revaluation gain, and it will be credited to the revaluation reserve account. So the deferred tax expense, additional deferred tax expense of 9,000, that is 30% of 30,000, must be disclosed as tax relating to the other comprehensive income. It is not relating to the profit and loss, but it is relating to the tax relating to the other comprehensive income. It will be debited to the revaluation reserve. So to create this deferred tax liability of 9,000, additionally you have to debit the revaluation reserve by 9,000. So revaluation reserve will be actually 21,000. 30,000 minus 9,000. And deferred tax liability will go up by 9,000. Is that clear to all of you? So can I move on to the slides? If you are done with the solution, I can move on to the slides now. Okay. I hope you are done with the solution. So let me go back to the slides. Last thing we'll talk about the difference between IFRS and US GAAP so far as accounting for current taxes and deferred taxes are concerned. So we'll talk about the difference between IAS 12 and the relevant provisions in US GAAP. One area is the tax basis. The US GAAP, under US GAAP, the deferred taxes, current taxes, deferred taxes are covered under ASC 740. So ASC 740, there are similarities between ASC 740 income taxes and IAS 12 income taxes. Under IFRS, for the area of tax basis, tax basis is generally the amount deductible or taxable for tax purposes. The manner in which a management intends to settle or recover the carrying amount affects the determination of tax basis under IFRS. Under US GAAP, tax basis is a question of fact under the tax law. For most assets and liabilities, there is no dispute on this amount. However, when uncertainty exists, it is determined with the ASC 740-1025. So under IAS 12, both and A740 both requires entities to account for both current tax effects and expected future tax consequences of events that have been recognized, that is deferred taxes, using an asset and liability approach. Deferred taxes for temporary differences arising from non-deductible goodwill are not recorded under both US GAAP and IFRS. And tax effect of items accounted for directly in equity during the current year allocated directly to equity. Neither US GAAP nor IFRS permits discounting of deferred taxes. Okay. Second area is taxes on intercompany transfers of assets within a group. When assets are transferred from one company to another within a group, IFRS requires that taxes paid on intercompany profits should be recognized as incurred. Also to recognize deferred taxes on temporary differences between the tax basis of assets transferred between entities or tax jurisdiction, because the entities may be in different tax jurisdictions. That must remain within the consolidated group. Whereas US GAAP requires that taxes paid on intercompany profits should be deferred and should prohibit the recognition of deferred taxes on temporary differences between the tax basis of the assets transferred between entities or tax jurisdiction that remain within the consolidated group. So these are the areas of difference between IFRS and US GAAP so far as accounting for current tax and deferred taxes are concerned. Any questions? Otherwise we will move to the next lesson, which is on currency. Now in this lesson we will talk about the currencies for an entity. What are the various, for an entity, what are the various possible currencies? That means currencies in which transactions are denominated. Currencies for an entity and accounting for foreign currency translations. So this is the purpose of this particular lesson, understanding the currencies for an entity, because nowadays most entities are doing transactions not only in their home currency, the currency of the country in which they are located, but also currencies of other countries. So what are the currencies for the entity and the accounting for foreign currency translations? That we are going to talk about. So what are the scenarios that require accounting for a foreign currency? So supposing an Indian company, when do you require to account for transactions done in a foreign currency? What are the scenarios that requires accounting for a foreign currency? The diagram here represents the various scenarios that require accounting for a foreign currency. It could be recording transactions in the foreign currency and subsequent settlement. So a transaction may be recorded in a foreign currency and the settlement also may be recorded in a foreign currency. Reporting for independent foreign branches. An entity may have a number of foreign branches, like a bank like State Bank of India. It has got a number of overseas offices, foreign branches. So when State Bank of India prepares its financial reports, they have to include the transactions which are done through the foreign branches. Reporting of foreign currency items in the balance sheet. The balance sheet may carry certain foreign currency items, like a loan may have been raised in a foreign currency. So reporting for foreign currency items in the balance sheet. And sometimes a company has got a foreign subsidiary. So when the parent company's balance sheet or financial reports are prepared, the foreign subsidiaries' financial performance has to be consolidated in the parent company's balance sheet. And the foreign subsidiaries are basically, they are doing transactions in the countries in which they are located, in the currencies of the countries in which they are located. So these have to be all consolidated into the parent company's financial reports. So these are the various situations when foreign currency transactions have to be accounted for. Either recording transactions in the foreign currency and subsequent settlement, purchase made in US dollar and its final settlement, payment for it. Reporting for independent foreign branches, reporting of foreign currency items in the balance sheet, and consolidation of foreign subsidiaries. These are the various scenarios when we need to account for foreign currency. So what are the currencies for an entity? One is the presentation or reporting currency. That means the currency in which the financial statements of an entity are presented. Like an Indian company will present its financial statements in Indian rupee. That is the presentation or reporting currency of the Indian company. Then second concept is the functional currency. The currency of a primary economic environment in which the entity operates. Now let's look at a US company which has a subsidiary in India. Now the subsidiary in India of the US company is owned by the US company, but the subsidiary will be preparing, or the subsidiary is operating in an environment in which the currency is Indian rupee. So that is functional currency for the subsidiary is Indian rupee. The subsidiary can still make the US dollar as the reporting currency, but the functional currency, that is the currency of the environment in which the subsidiary, US subsidiary is operating, is Indian rupee. So that is the functional currency of the subsidiary. Third is foreign currency. Currency other than the functional currency of an entity. So the US subsidiary of the Indian the Indian subsidiary of the US company is doing some transactions in euro. That will be a foreign currency. So three cases may arise. First one is the presentation or the reporting currency. That means the currency in which the financial reports are prepared, or financial statements are presented. That is called presentation or reporting currency. The second is the functional currency, the currency of a primary economic environment in which the entity operates. So for an Indian entity, the reporting currency and the functional currency could be same. For an Indian company which is operating in India, both the reporting currency or presentation currency and the functional currency will be Indian rupee. But for US subsidiary, but for a US subsidiary of an Indian company, the presentation currency may be Indian rupee, but the functional currency of the US subsidiary will be US dollar. And third is the foreign currency, which is currency other than the functional currency of an entity. So three kinds of currencies, concept of currencies we have. One is the reporting or presentation currency, functional currency, and the foreign currency. So the conversion of financial statements of a foreign entity into financial statements of a reporting entity, how it has to be done. Supposing, take the case of a Indian company which has a subsidiary in US. The subsidiary is a US entity. But basically the financial statement of the US entity has to be converted into financial statements of the reporting entity, maybe the Indian parent company in the India. The reporting entity, when it is presenting a consolidated financial statements including its own performance or financial position along with the subsidiaries' performance and financial position. So for the Indian parent, the currency, reporting currency is Indian rupee. But for the US subsidiary of the Indian company, the functional currency is US dollar. And the US subsidiary of the Indian company may be doing transactions in various other foreign currencies also. So how to convert it? So what are the rules for converting? Have you done with the previous slide? I have put it on the screen, Divakar. So when you are done with that, please let me know. because I have to move to the next slide. Should not take this much time. So hopefully you are done. Okay, thank you. So the conversion of financial statements of a foreign entity into the financial statements of the reporting entity, how it is done. All transactions done in foreign currency, that means neither in the currency of the reporting entity nor in the currency of the functional currency of that foreign subsidiary, foreign entity. All such transactions, foreign currency transactions will be converted to the functional currency or remeasured in the foreign currency, functional currency first. So the US subsidiary of, let's take the situation. Let's consider the situation where there is an Indian parent company. So there is a parent company, is an Indian company. It has a US subsidiary. US company as its subsidiary. Okay. The functional, for the parent company, the reporting currency or presentation currency is INR. Okay. For the US subsidiary, the functional currency is US dollar. Now when the financial statements of the US subsidiary has to be consolidated into the financial statements of the Indian parent, it is to be done. So all transactions done by the US subsidiary in Euro, Japanese yen, these are all foreign currencies, GBP. So if the US subsidiary is doing transactions in these currencies, these are basically foreign currency. So all such transactions which are recorded there in the books of the US subsidiary in foreign currency has to be converted or remeasured in US dollar. Then the US subsidiary's position as reflected in the US dollar will be translated into Indian rupee or the presentation currency. That is how it is done. So conversion or remeasurement of foreign currency into the functional currency and then translation of the functional currency into the reporting currency. That is it's done. That is how it is done. Is that clear? So you look at a case study to understand this. ABC Bank is incorporated in the UK. That's a Standard Chartered Bank or a Barclays Bank, which is incorporated in the UK. It has ABC India branches that perform full-fledged banking operations in India. So Barclays Bank or Standard Chartered Bank, they have full-fledged branches in India who are doing banking operations in India. Now consider the following questions. What is the presentation currency of ABC Bank parent company while doing group consolidation? The presentation currency of the ABC Bank parent company which is incorporated in the UK will be GBP. Even when doing the group consolidation, the presentation currency will be GBP. The functional currency of ABC Bank parent company is also GBP. But the functional currency of ABC India branches, Standard Chartered Bank of India branches in India or Barclays Bank branches in India will be Indian rupee. Now if a branch of ABC India branch imported a specialized dedicated server from an entity in the US and it has been invoiced in US dollar, the US dollar is a foreign currency for the ABC India branch. So for the ABC India branch, the functional currency is Indian rupee because they are operating in India. The branches are operating in India, doing banking operations in India. Now the branch of ABC Bank in India, it imported a specialized dedicated server from an entity in the US, which has been invoiced in US dollar. So the currency US dollar is basically a foreign currency for the ABC India branch. These are the meanings of reporting currency, representation currency, functional currency, and foreign currency. Is that clear to everybody? So foreign to functional. So conversion, remeasurement and conversion of foreign currency to functional currency. How it is done? Initial recognition of the foreign currency transaction in the functional currency recognizes a transaction at the rate on the transaction date. So when I recognize a foreign currency transaction in the functional currency, that means ABC India branch imported that dedicated server from the US and it was invoiced in US dollar. So when this purchase is done, purchase is recognized in the books of accounts, the initial recognition of the foreign currency transaction, it has to be recognized in the functional currency. Instead of US dollar, it will be recognized in Indian rupee. And applying the rate which is applicable on the transaction date. So if on 25th of April the purchase is made, US dollar 100,000 is the value of the invoice of that server, then it has to be recognized as a purchase. Purchase account will be debited with the equivalent Indian rupee, applying the spot exchange rate on the day of transaction. That is 25th of April. There is also an option of using the average rate for the week or the month. So instead of using the spot rate of the day of the transaction itself, the average rate for the week in which the transaction was conducted or the average rate for the month in which the transaction was conducted can also be done. It is optional. Either the spot rate between Indian rupee and US dollar on the day of transaction or the average rate for the week or for the month in which the transaction was conducted can be used for initial recognition purpose. Subsequent recognition. The day the purchase has been made, the payment to the US supplier may not have been made. The payment could be made after 2 months. That is settlement. So subsequent recognition, the following figure represents the remeasurement on subsequent reporting. So for monetary, there are two distinctions here, monetary items and non-monetary items. What are monetary items? Other items in the balance sheet. That is non-current assets, inventory and investment. These are called non-monetary items. Like say, the server will be a non-monetary item because the server will appear as a fixed assets, non-current asset in the balance sheet. In respect of monetary items reporting at a subsequent date, units of currency held and assets and liabilities to be received or paid in a fixed or determinable number of units of currency, for example, cash. Like say, a company, the Indian branch of the ABC Bank is holding some foreign currency in there because they are doing foreign currency transactions also. They are selling and buying foreign currency. They are offering foreign currency services to the customers. So they may be holding some foreign currency notes. So these are monetary items. Units of currency held and assets and liabilities to be received or paid in a fixed or determinable number of units of currency. For this, retranslation subsequent measurement has to be done using the closing rate, that is the year-end exchange rate. So the ABC branch Indian branch of ABC branch is holding say 5,000 US dollars currency notes. This is monetary item. This has to be retranslated. The value of that will be retranslated. When they purchase the currency notes, that will be the initial recognition. Subsequent recognition on the reporting date, you have to use the closing rate or the year-end exchange rate for valuing that monetary item. Exchange difference, supposing 5,000 US dollar currency notes have been purchased from a tourist by the ABC branch of, let's look at a monetary item. So ABC Bank's branch in India Because you know the banks purchase and sell foreign currency notes. The ABC Bank's branch in India purchased $5,000 from a tourist, from a US tourist who came to India. He wanted to exchange $5,000 into Indian rupees. So the rate was, let's say, at the rate of rupees 65 equal to $1. So initial recognition will be 5,000 into 65. That is the initial recognition. That is the initial measurement of this. This is an asset. Initial measurement of the asset will be, let's say it happened on 29th December 2016 or 29th March 2016. Now on 31st May 2016, that is the closing or reporting date, the $5,000 are still held by the ABC Bank's branch, Indian branch. So how it is be subsequently recognized or subsequently measured? Let's say on 31/60, $1 equal to rupees 66. So what will happen? The value of this which is earlier taken as 3,25,000. That was the initial recognition, INR 3,25,000. Now it will be 5,000 USD into 66. So INR 3,30,000. So it will be shown in the balance sheet at INR 3,30,000. That is the subsequent measurement. So for monetary items in the balance sheet, subsequent measurement will be done at the exchange rate applicable on the closing exchange rate, that is exchange rate applicable on the closing date between the foreign currency and the functional currency. The difference, 5,000, will be either charged to the profit and loss account. So it will be charged to the profit and loss account. That is how for monetary items it is done. But if it is a non-monetary items, like a non-current asset, like a dedicated server purchased by the Indian branch of the ABC Bank, what will happen? For non-monetary items, like non-current assets, inventory, investments, etc., do not retranslate. Items will be maintained at a historical cost, recorded at the exchange rate on the date of acquisition. So we don't have to retranslate them. So if the purchase was made of the dedicated server $1 lakh, it was made, purchase was made on, let's say, 8th of September 2015 at the rate of $1 to 64, then 64 lakhs is recorded as the cost of that dedicated server, so it will be maintained at that cost. Of course, you have to charge depreciation and all that, but it will not be retranslated using the closing exchange rate. So items at a historical cost recorded at the exchange rate on the date of acquisition. Items which are at fair value or revalued items, this will be translated and recorded at the exchange rate at the date of revaluation. Some items are there which are always measured at the fair value, or there are revalued items. Then this will be translated and recorded at the exchange rate as on the date of revaluation. That applies for remeasurement or subsequent reporting of monetary items and non-monetary items. Is that clear to you? Because I am not going to proceed further. We have just discussed about conversion or translation or reconversion translation, basically from foreign currency to the functional currency in respect of monetary assets and non-monetary assets. Initial recognition always will be at the exchange rate on the date of acquisition, on the date of the transaction. But subsequent report for subsequent measurement or for reporting on the reporting on a subsequent date, it may be remeasured. In case of monetary assets, this should be remeasured using the exchange rate, closing exchange rate on the reporting date. But for non-monetary items, the items can still be measured at the initial historical cost, that is the initial recognition, whatever measurement has been done, they can be continued unless they are revalued or there is a fair valuation. The items will continue to be measured at the initially recognized value. No need to use the closing exchange rate. Only if there is a revaluation, then the exchange rate on the date of revaluation can be used for the revalued items. That is what applies. This is the how foreign currency to functional currency conversion takes place. So I will not proceed further today because we are approaching the closing time. So I will request you to complete your feedback, and if you still have any questions relating to what we have discussed today, particularly deferred taxes and also foreign currency and currencies, you can ask it. So if you have any further query, you can ask it now. Otherwise, we'll close the session today. We'll again meet on Friday, same time. So okay, thank you. So let's close the session today.